Picture this, a tug of war between dreams and debt, where stakes are higher than ever. The real estate market, once a realm of endless possibilities, now faces a formidable challenge: rising household debt. That's right, folks. The Consumer Debt Report was just released the other day, and it reveals some alarming information. And this information is important to you, especially if you're thinking about buying or selling real estate in the near future. Now, as I mentioned, this report was just released and it is alarming, and well, we're setting records, folks, and not the records that we want to set. In this video, we're gonna go over this report, well, some of the findings in the report, and we're gonna unveil how some of these things may impact you if you are thinking about transacting. What exactly did this report have to say, and why is it so alarming? Okay, so according to this report, consumer debt has reached an all-time high of 17 trillion, with a T, trillion dollars, which has surpassed any year we have ever seen. Now, mortgage debt represents the largest portion of consumer debt, and it's accountable for about 68% of overall debt. And although we are considering debt overall in this report, I want to talk and focus on a little bit more around some of the other moving mechanics, more of the short-term debt rather than the long-term debt, which again would be the mortgages. Short-term debt would be anything like credit cards, car payments, home equity lines of credit, anything that has a much shorter repayment period, okay? Where most mortgages are 30 years in length or 15 years in length, there is a much longer repayment process when it comes to a home mortgage. So if we take a step back and we ask ourselves, why are we seeing this huge increase? What are the factors that are contributing towards this spending? Well, let's just take a look at the last few years, okay? Not to get into politics, but there were a lot of grants. There was a lot of money that was given to consumers, which consumers went and formed habits to go out there and buy things that they either didn't need or that they've longed for and could never afford. And that spending created some habits, right? And well, those habits just don't go away easily. Once people start to spend, it's contagious and they continue to spend. But that's not really the key or the only reason why people spent a lot of money. We also, over the last few years, have been in a world where everything has cost us way more than it has in the past. And yes, we hear this buzzword of inflation, but aside from inflation, think about just even the rise in housing prices. When the pandemic came around and people went to buy cars, even the price of cars shot through the roof. So regardless how you look at it and whether or not you want to correlate it directly to inflation, we can't discount the fact that the things that we need to survive, our everyday goods, have gone through the roof. And well, a lot of times those goods and things that we need, they get put on credit. And generally when goods go up, which is known as the cost of living, well, usually we see wages go up. But wages have been stagnant, or at least have not been increasing at the same rate that our goods have been appreciating, okay? Or increasing, I should say. So when everything costs more to buy, but we're not being compensated more to buy those goods, as you can see, that divide will continue to spread. And well, we will end up putting ourselves in a situation where if we don't get ahead of our spending or maybe change some of our spending habits, we very well might be in a scenario where our credit card debt will just go up and up and up. And don't think that credit card companies are foolish. Trust me, they are anything but foolish. When they see this demand for consumers to spend and use credit cards or credit, what do you think they're going to do? They're going to offer you opportunities to obtain credit. So over the last few years, credit has been very easy to obtain. A lot of people who have never had credit, poor credit, or a lack of credit history were given credit to use, and they used it, well, they didn't use it sparingly per this report. That's why we have all of this consumer debt, right? So factoring in those three things right there, again, rise in consumer goods, stagnant wages, and credit just being given out to anyone and everyone, it's kind of a perfect combination or the perfect storm for the overall household debt to increase. But what does that mean exactly to people who are looking to engage in the real estate market, buyers and sellers? Well, the short answer to that is you may not realize it, but the fact that you may have so much debt may very well impact your ability to get a loan. And at the end of the day, well, it could also greatly impact the terms that you get for the mortgage. High debt to income ratios greatly impact the amount of money that a borrower can get. So if you have a lot of debt and not a lot of income to support that debt, you very well may not get approved for the amount of money that you're hoping to get approved. And then obviously will trickle down to the sellers. If we are taking away buying power, we have less buyers in the market. Well, given the current market being that inventory is so low, I don't think it's going to completely rock the boat and put sellers in a bad spot, but it will definitely impact the real estate market overall. It will definitely reduce the amount of buyers that are out there, which I can't say is a bad thing because we definitely need more inventory. But the moral of the story is that it will impact sellers because sellers won't have as many well-rounded, motivated buyers to make offers on their property. Now, I bought my first house at 21, roughly 20 some odd years ago, but in today's market, millennials and other younger people aren't buying homes at an early age. As a matter of fact, they're staying with their parents or friends or roommates and renting a lot longer than they usually would have, because even college debt and the debt that is accrued during college it's astounding. These are kids quite often who aren't given any education when it comes to finances, and they're given credit cards and they're set out into the world to fend for themselves, literally. And what do you think happens? They come back with credit card debt and they come back with schooling debt, which again will put them in a position where they either can't afford to buy a home, don't qualify to buy a home, or simply don't have the desire to buy a home because it's just too expensive. Now, if you're a homeowner and you're not thinking about selling, guess what? This still may impact you as well. That's right. As these interest rates continue to climb, as I mentioned, those interest rates impact short-term debt, your credit cards, your car payments, your home equity lines of credit. Okay. And those rates are going up. So if you have balances on your credit card and you're not paying them off, your monthly payment just to maintain those credit cards will continue to go up, which is going to put a burden on homeowners, right? Theoretically, this additional pressure could result in homeowners falling behind on mortgage payments, or more drastically, not being able to make mortgage payments. And it could even get to a certain point where it could limit or hinder your ability to refinance your loan to either a better rate or a cash out refinance or anything along those lines, because, well, we use our homes a lot of times as a piggy bank, or we should be using it as a piggy bank, but using it correctly, not to go out and buy things that we don't need. But in the event that you ruin your credit or you have too much debt, you will not be able to refinance your loan or take out a home equity line of credit, regardless of how much equity you may have in it. And let's not forget the pressure that comes with having debt and having to put food on the table while also making sure that the mortgage is paid, simply so that the house isn't foreclosed on. As you can see, the rising debt affects everyone when it comes to real estate. Well, not everyone, but it affects the buyers and the sellers, the people who are in real estate or people who own real estate. Now, there's something that I found to be relatively interesting, and people love to compare the current real estate market or where the current real estate market may go to our previous housing collapse in 2008. And I was also a licensed realtor in 2008. As a matter of fact, I almost lost my home in that previous housing crisis. But since people love to compare, I'm going to go ahead and compare as well. And what I'm not going to do is I'm not going to do an apple to apple comparison. But what I want to point out is something that I'm noticing or I'm seeing, and it's a trend. Before, in the previous real estate market, before the previous crash, let's just say 2006, 2007, people were refinancing their homes or selling their homes to simply scale up in life. They would move from their smaller first-time home buyer home. They would take that equity and they would roll it into a much bigger home. Unfortunately, they rolled it into a home that they couldn't afford. Instead of scaling up, they literally leaped up. They leaped to a property that they just, at the end of the day, could not afford. But what we're seeing today is a little bit different. Now we're seeing people instead of refinancing their home or taking the equity out of their home to scale up or use their credit cards to provide a better quality of life, now we're actually seeing credit usage being used to maintain current lifestyle. Instead of scaling up, people are using their credit cards to put food on the table. People are using their equity to maintain their mortgage payments or maintain their car payments. And that is extremely frightening because, well, if people don't have equity and they're using the equity to pay the balances on the loans and the credit cards that they have, they're going to eat up their equity to pay off their debt only to find out that they have, well, no equity. And that can trap you in your home, especially if you're hoping to move, whether it be in a few years, few months, whatever it may be. But once you exhaust all of the equity in your home, well, that really puts you in a tight position. We should either be striving to gain equity or striving to use the equity in our home for gain, not to keep us complacent. And that, I think, is one of the most alarming factors that I'm seeing when it comes to consumer debt. So here's my takeaway. Do your best to get a grip on your spending. Rather than calling your credit card company and asking them to raise your limit, call your credit card company and negotiate your interest rate. See what you can do to get a better interest rate, because that will help you pay those balances off a lot faster. And if you have equity in your home, well, using it to pay off credit card debt, I'm not going to say is a bad thing, because usually the interest on your mortgage is a lot less than the interest on your credit cards. But what you don't want to do is you don't want to get to a point where you have exhausted all of the equity in your home to pay that debt off, because again, it then limits your opportunities or your ability to sell that property or to make moves. So again, this is some pretty alarming information. I'm hopeful that the next consumer report will show less debt, but the way things are going right now, I don't think that's going to be the case. So let me know what you're seeing out there. Let me know if you feel as though debt is rising. I personally can feel it. I can tell you personally that my credit card balances are higher than they were before. With all of that said, I'm Chris Nelson, team lead of the Nelson Home Group. I hope this message was of some value to you, and until next time, take care.